Hi everyone, welcome to today's video. So on today's video, I'm going to speak about how you can build a very big portfolio. Short answer is that become a politician, and to imbibe that spirit, I'm wearing politician's clothes. No, on a serious note, on this video, I'm going to teach you a step-by-step process as to how you can build a big portfolio. The honest short answer there is that you actually need to make a lot of money and you need to invest it intelligently. And you'll say, okay, that sounds like fairly simple. What is it that you're talking about? Why is this complicated? You will understand the entire story. So let's kickstart our story by understanding how Mr. Nikhil Kamath, who is the co-founder of Zerodha, invests his money. So he has publicly disclosed it that this is where he's investing his money, and I will take you through it. Very interesting findings. So first and foremost, you will see that he invests only 50% of his money in equities. Now here we are speaking about the co-founder of Zerodha. He does not put his entire money in equities. He invests only 50% there. Debt, he's taking like 43%. Gold, he's buying a little bit. Real estate, he's buying a little bit. So to cut the long story short, despite running one of the biggest investment platforms in the world, Mr. Nikhil Kamath does not invest his entire money in equities. And there were a lot of questions asked around it. So I will explain it to you. Why does he do that? At least as per my understanding. On the flip side, if you consider the investment portfolio of different investors like Mr. Warren Buffett, he does not buy gold. He does not buy real estate. He does not buy bonds. Now, according to him, all these things are bad. So one can assume that he invests almost all of his money in equities. So he's a pure equity investor. Now, on the other side, if you consider the investment portfolio of Mr. Anupam Mittal, who is a shark on Shark Tank, he does not invest, at least it looks like that he does not invest any money in equities, bonds, this, that. He invests most of his money or almost all of his money in doing angel investing, which means that he picks his money, whatever money he has, and he puts it in startups. So why am I telling you all these three disassociated stories? Well, the answer there is very simple, that every investor is of different type. You will have a natural response, yaar, aaj I read about Mr. Nikhil Kamath, Nitin Kamath, he's investing his money this way. I today read about Mr. Warren Buffett, he's investing his money this way. I today read about this third big investor, he invests his money this way. So I will probably go and copy their style. Now this is the worst mistake that you can make in terms of investing, because all these three people are probably sitting on thousands of crores. They have a fairly big portfolio and they have very different investing style. So what this leads to is that when you absorb this type of commentary, it creates a lot of confusion in your head. So what I'm going to do on this topic is very simple. I will tell you a step-by-step process as to how a general investor who has a full-time job, student, does not know much about finance, what are the steps that you need to keep in mind कि पहले घर खरीदें या equities में invest करें, bonds में invest करें, where is it that you should be investing first, and how your portfolio should grow with time. This is one of the key questions that very few people are able to answer. So I'm going to show you a roadmap. My push is not that you go and invest your money this way only or that way only. I will tell you and guide you in terms of just creating a roadmap for your investing. Curate it as per your investing style. So let's kickstart our video, and along the way, I will also reveal how is it that I'm cultivating my portfolio. Right now, I invest approximately 80% of my money in equities, but going forward, this will be brought down to 50%. So I'm going to reveal the answer as to why I will be making that change. Everything will become crystal clear if you watch this video till the very end. So humble request that please like these type of videos. It will make more people financially aware. So let's kickstart. The first key thing that you need to do in order to create a big portfolio is that you need to understand the big portfolio math. Now, what is the meaning of big portfolio math? For example, according to you, 10 crore might be a lot of money. Now, if you go and ask your friend, maybe he or she will say, yaar, 5 lakh is a lot of money. If you ask me, I might say 100 crores is a lot of money. If you ask some big investor, then they might say that 5,000 crore is a lot of money. So the definition of big portfolio is not standard, but let's just assume that you want to make roughly 100 crore rupees. So what is it that you will need to do, practically speaking? So this chart provides you all the mathematical calculation. So assume that you are able to invest 50,000 rupees per month and you are able to grow your money at 12%. Now growing your money at 12% is not hyper complicated. Even if you are doing mutual fund investing, even if you are buying equities on your own, this 12% return can be easily generated. What makes me say it? Because the last 20-year CAGR of Nifty has been more than 12%. So from that perspective, generating this 12% is not impossible. Now you might have an investment age, maybe you're like 20, 30, 35. You are going to live till 70, 80. That is what the average lifespan tells us. So you have an investing career of 40. So if you do all this math, then the number comes out to be roughly 60 crores. Now you'll say, yeah, you said 100 crores, this is 60 crore. Why? There is step up that is going to happen, right? It's not as if that you will forever invest this 50,000 rupee only. Your salary might increase with time. So therefore, if we do this rough math, that right now, if you're 35, you're able to save 50,000, then by the time you retire and you have an investment journey of 40 years, you can definitely build a portfolio of 100 crores. Now, a lot of counter questions will be there. That us paise ki value kya hogi? Inflation will eat it up. There will be so much taxes we'll have to pay. Agree. I'm not debating that. I'm just simply telling you, I 100% agree with all those points. What I'm simply trying to tell you is that you can actually generate that 100 crore rupee portfolio, which is a fairly big portfolio, irrespective of how we look at it. It is a fairly big portfolio and you can easily generate it if you are able to keep up with your investment journey. And if you continue to invest, this is such an important point that if you do not invest, your money will not grow. So then comes a natural series of questions that, okay, in what step should we invest? Should we first buy a house? Should we invest in bonds? So let me answer that one by one. So the first step in this journey should be to fill your emergency fund. Now, what is the meaning of emergency fund? And more importantly, what is the goal of emergency fund? Well, the goal of emergency fund is fairly simple. It is to keep your active income alive. Now, what is the meaning of active income? For example, if you're going to office and at the end of every month, you are, let's say, hypothetically making a salary of 40,000-50,000. Now, that is the active income that you have. Now, if unfortunately something happens that, for example, you meet with an accident or you are fired from your job, bunch of problems can happen, right? And then your salary or that active salary might go away. So you must have a little bit of emergency fund stocked somewhere so that you can at least look for another job. And meanwhile, your standard of living is not suffering. So to cut the long story short, your step one in terms of your investment journey is to fill up your emergency fund. Now, for some people, they say that your emergency fund should be 6 times your monthly expenses. So for example, if your monthly kharcha is 50,000 rupees multiplied by 6, so roughly 3 lakh rupees should be stashed in FDs or highly liquid assets as your emergency fund. So please understand the goal, that the goal of emergency fund is that it helps you deal with emergency like situation and somewhat jump onto that bandwagon of active income creation. The goal of emergency fund is not कि यार inflation beat कर देंगे and all that stuff, right? For that, you need to go to other instruments. So now comes step 2 of your investment journey. On step 2, your goal is to create a safety nest. Now, what is the meaning of safety nest? Safety nest simply means that, okay, this is the money that is not going to hurt badly in case something bad happens. For example, many a times you would have observed कि यार market में वैसा लगाया, in the stock market I put like 10 lakhs this year. And unfortunately, 2 years, there is no growth that has happened in the stock market. So your 10 lakh stays 10 lakh and sometimes it even falls. So making these type of investment is not called as safe money or safety nest type of investment. So go back to Mr. Nikhil Kamat's portfolio. What he is doing is that he is investing 40-50% of his money in debt. Now, why is he investing 40-50% of his money in debt? Should you be doing it? Should you not be doing it? So let me give you a very quick crash course on that. Now, this entire question, whether you should be investing 40-50% or maybe like 10%, 15%, 20%, what does this depend on? Well, this depends on 3-4 things. So first key thing is that you must understand the goal of debt investing. Now, what is the meaning of debt? Well, there are a series of instruments or assets in which you can invest. I had done separate videos on debt, so please go and watch it. But very quick refresher is that in the market, there are 2 predominant type of asset classes. I'm not saying that only 2 asset classes, but predominantly there are 2 asset classes. One is called as equity. Equity means that you go and buy ITC stock. So what are you doing? It's a stock. Stock means equity. So you are going and buying something called as equity or a stock. Now, what is the issue with equity or stock? Now, equity or stock is inherently more risky. Now, why is that the case? I'll explain that in a minute. But on the flip side, there is another instrument called as bond. Now, what is the meaning of bond? Bond simply means that, for example, you would have heard that government of India issues a bond. Now, what is bond? Bond is basically a piece of paper. Now, on this piece of paper, it is written that if you give us 100 rupees, then after 3 years, we are going to pay you 115 rupees. So this is what a bond instrument might say, and the conditions can be changed. But the benefit of bond investing is that it is slightly less risky compared to equities. So a lot of people like Mr. Nikhil Kamath, they do put in a lot of their own money in bond instruments. Why is that the case? Because they want to decrease the risk in their portfolio. Now, there could be 100 different reasons why you would want to reduce the risk on your portfolio. The simple reason there could be that the portfolio size is already very big. Now you're sitting on, let's say, 1000 crore. Now you don't necessarily need to make 15% CAGR on this 1000 crore rupee of personal portfolio. What are you more bothered about? You might be more bothered about कि यार ये 1000 करोड़ रुपए हैं. ऐसा ना हो कि I make some bad investments and this goes down to like 100 crores. This second scenario is something that you might be more scared about. So according to me, Mr. Nikhil Kamath, what he simply does is that because his portfolio is fairly big, so he might be looking to reduce his risk profile. You might have a counter question that, okay, then why is it that Mr. Warren Buffett is all into equity investing? Why does he invest almost 100% of his money in equities? There can be 100 different reasons. For example, he might be a highly skilled investor. He might be having more privileged information. So I can't exactly tell you why is it that person A is investing some money in bonds. Why is the other person not doing the same? Because there is no right method. You have to pick as per your investment style, your investment philosophy, and your goal. Many a times you would have heard that when you are investing, decide your goal. What does that mean? It simply means that, hey, are you okay? What is the option that you are executing? 1000 crore? Are you looking to grow it to 1100 crores by next year? Or are you of the opinion कि ठीक है यार गिरना नहीं चाहिए बहुत ज़्यादा? That is what I'm more concerned about. So that depends on your goal. Another thing could be that you might end up taking a lot more debt position if you have multiple sources of income and certainty of income. For example, if you are sure कि अगले साल or next year you are definitely going to make 2 crore rupee or very high probability that you are going to make 2 crore rupee because you have 20 businesses. 5-10 तो चली जाएंगे. Then what is the point? Then you probably can take a little bit more risk. So you would invest less in debt and more in equity. Because the good thing about equity is that the risk is high, but the returns or potential of returns is also higher. The issue with debt is that, okay, the risk is low, but the returns or expected returns are slightly lower. So you have to do that trade-off. Now, if you're in a stable job, for example, you're certain कि यार I have a government job, पैसा आना ही आना है. So from that perspective, again, you might not be putting a lot of money in debt. Now comes the natural question that, okay, I'm looking to invest in debt. What type of debt I should buy? What type of debt I should not buy? Where should I buy it from? So for that, you can check today's sponsors, which is Golden Pie. It is India's #1 bond investing platform. And the best thing about Golden Pie is that you can actually go on their platform and pick whichever type of debt you are looking to invest. For example, you can go and do corporate fixed deposit. You can do NCD IPOs. You can buy listed corporate bonds. You can buy sovereign gold bonds. And there are a bunch of options that you can explore as per your risk profile. For example, you can simply go on this safety rating feature and click on AAA, and you will get instruments that have been vetted, which are of fairly high security. So coming back to the topic at hand, the second step in your investment journey is to create a decent size safety net. It will depend on a bunch of things: what type of job you have, what is the expectation of cash flows that you have next year. All that stuff will go into the picture, but you need to make a call whether you want to invest 10, 15, 20% of your money, or maybe even 40, 50%, depending on your risk profile and risk aversiveness. Now, if you ask for my safety nest rule, I would say that at least you should have approximately 2 years of your salary as safety nest. This is what I would recommend in terms of your safety nest. Put that into the bond market. The goal of bond market is very simple, that it is at least to match inflation. And there are a series of bonds that you could consider on Golden Pie from that perspective. Now then comes step number 3. This is the step that all of us get super excited about, which is stock investing. Now, I have seen many college students jumping into like stock investing, taking very risky bets, all that stuff. Maybe it's okay to do it, maybe it is not okay to do it, but at least listen to the basics. So there are 3-4 basic points that you need to understand about stock investing. So the first key basic point is the goal of stock investing. The goal of stock investing or going to a riskier segment called stock is to beat inflation. Now, if the inflation in the economy is, let's say, 7%, and if your equity portfolio is giving 6% return, stock market chhod do, right? Go to bond investing, go to some other form of investing, give your money to mutual fund managers, whatever you want to do. Please do not invest in the stock market. I'm telling it to you point blank. Or learn about stock market. But the basic bottom line is that you must, whenever you are going to the stock market, your simple objective is to beat inflation. If you can't do that consistently, please move away from the stock market. This is the #1 harsh tip that I'm giving you, straight point blank, in no nonsense fashion. Now, when you're jumping into the stock market, please understand 3 central things. First is that there is something called as aggressive stocks and defensive stocks. Now, what is the meaning of this? Now, there are certain stocks that will go up not very aggressively and they will not fall down very aggressively also. For example, consider the case of Hindustan Unilever. Now, it is an FMCG company. अब ऐसा तो होगा कि next year, this year you're using like 5 bottles of shampoo in a year. Now, next year suddenly you start using like 20 bottles of shampoo each year. So their sales is not going to grow up like crazy. Yes, there will be inflation, all that stuff. So companies do benefit, but the HUL's product are not going to rise like crazy, right? And also not going to fall like crazy. So therefore, it is a defensive stock. Now, when you are beginning your stock market journey, be very focused in terms of buying defensive stock. Because what is the biggest roadblock in terms of creating your big portfolio? Well, it is the fact that you stop investing altogether. So how not to stop investing? Very simple. That do not take like massive losses in the stock market, especially when you are starting your stock market journey. And how to do that? That initially, when you start investing, please buy defensive stocks over aggressive stocks. So this is the first key thing. Now, very quickly wrapping up, what is the meaning of aggressive stocks? It's very simple. Aggressive stocks are more like banking stocks, tech stocks. So these stocks go up in value also very quickly and fall down in value also very quickly. So when you're starting your stock market journey, buy mostly defensive and buy large cap companies. Large cap means big companies whose market cap is fairly big. So these are fairly stable companies. They will not get evaporated also, and it's not as if that they are going to give you crazy returns. But when you're starting, and if you follow this simple rule, you are not going to undertake massive amount of hit, massive amount of losses, and you will continue to invest. That is the first key thing that you need to understand. Now comes the second key point, that your portfolio should be divided into core and non-core. Now, what is the meaning of core and non-core? According to me, core portfolio means that these are the stocks that you are willing to hold for a substantially long period of time, unless the business fundamentals change or you see something going off completely. Non-core means that these are your opportunistic trade. For example, right now, IT stocks have fallen quite a lot. Now, I am not a big believer in the Indian IT industry, but I have started to aggregate a lot of IT stocks. Now, which ones? I will give the commentary on the member community tab. I keep on giving daily commentary there. So in case you are a serious investor, you could consider joining it. So I outline my buy sell decisions there. So anyways, coming to the topic that these are opportunistic trade. Now, for example, I am aggregating IT right now. Few months down the line, if it goes up, I will sell it and I'll be completely out. So for me, Indian IT are my non-core portfolio stock, and my core portfolio stocks would be something like HDFC Bank, Hindustan Unilever, some good small caps also. So those are stocks that I'm willing to hold for a substantially long period of time. Now, the important and the most important part is that as you grow older, so let's say that you're 20 years and you have invested 50,000 rupees in the stock market. Now, 50,000 rupees to a 20-year-old might be a lot of money. But imagine that when you're 40 years old, 50,000 rupee in the stock market, is it very big? The short answer might be no. Itna nahi hai, theek hai, it's not that big a deal. So what is happening is that as you grow older, your portfolio is likely to grow. So when you are on the younger stages here, it is okay to make mistakes, learn from those mistakes, vagera vagera. But with time, most of your money should be rotated into assets where you are fairly confident. So from a stock market term, where should most of your money lie when you're 40 years old, and let's say you have a portfolio of 40 lakh, where should it be? It should mostly be in your core portfolio stocks. So that brings me to my answer that, okay, Akshat, right now you are 80% in equities. So why did you say that you will bring down your equity portfolio to 50% over time? Now, there are a bunch of reasons, but one of the core reasons is that my portfolio is already fairly big. I am not at this stage. I am not looking to grow my portfolio at a crazy rate. I have been able to generate 15 to 20% CAGR by taking low risk. So going forward, because my portfolio is fairly big, I would want to reduce risk on my portfolio. So let's imagine that I already have a 100 crore portfolio. I'm not saying that I have 100 crore portfolio. I'm simply using it as an example to illustrate the point. So if I have 100 crore portfolio and I'm 35 right now, so by the time I'm 40, let's say that I have 150 crore portfolio. So then the idea is that I will keep almost like 75 crore safe, right? So from that perspective, I will invest less and less in equities. It does not make me a dogla insan that, you know what, I'm teaching about stock market and not investing in the stock market. No, his perspective is different. He is trying to lower the risk on his portfolio. portfolio. It is fairly easy to take risk with 50,000 rupee, but when you have 100 crore, 200 crore rupee portfolio, you might want to lower your risk. And that is the reason why a lot of people, as they grow older, they shift more towards debt. They shift more towards real estate. So all those things keep on happening. So now finally covering commodities or slightly more fixed supply assets. I'm not saying perfectly fixed supply asset, but slightly more fixed supply assets. See, there are a bunch of fixed supply assets. For example, when you consider gold, the supply of gold cannot go up by more than 2 to 3% in a usual year. So the supply is somewhat fixed. It is not going up like crazy. For example, infinite amount of money can be printed, but infinite amount of gold cannot be printed into the economy. So it is a fixed supply asset. Same goes for Bitcoin. Now I know I'm going to get a lot of hate. It's your wish whether you want to learn about that asset class, not want to learn about that asset class. I'm just telling you all the options that are there. Then comes real estate also. Now see, what ends up happening is that all these things are converted into weird assets. For example, gold or real gold is a real asset. But when you convert it into sovereign gold bond, now sovereign gold bond is backed by what? It is not backed by real gold, right? So if you are investing in a fixed supply asset and you say that I'm buying sovereign gold bond, then your purpose of getting into this asset class gets defeated. Now REITs, what does REITs consist of? At the back end, it consists of flats also. It consists of multiple buildings also. If your goal is to buy fixed supply asset, what is it that you should buy? You should buy an asset or a real estate where you own the land, right? So I hope that you get this basic categorization. In this section, I'll not go in depth explaining what REIT is or what sovereign gold bonds are. If you love them, please go and buy it. But the objective of buying is very, very different here. If your objective is buying fixed supply assets, then you should be buying physical gold. You should be buying something like BTC. You should be buying land or villas or factories where you own the land. So those are your options of buying fixed supply assets. Now you might have a natural response that, okay, what is the need of buying these fixed supply assets? That's a very good question. Well, we live in a very highly uncertain world where inflation can go up substantially. It is already going up substantially. You might have already seen in cities like Bangalore where the landlords suddenly doubled the rents for the tenants. Do you think that this is the last time that is going to happen? No, this will continue to happen till the time we live in a high inflation, high interest rate type of a world. If there are problems or risk associated in the economy, then these real fixed supply assets are somewhat real assets, so to say. They generate real cash flows. Now, for example, I purchased a villa in Goa. Now, let's say that this year I'm charging 10,000 rupees per day for that villa. Now, suddenly the inflation in the economy goes up. Do you think that I'll not be able to increase the prices of that villa? I will be, because that villa is a real asset. I own the land. Now you might say that a flat is also that. Yes, theoretically it is. But again, is it like really fixed supply? Are you owning the land? So these are some of the questions that you need to ponder upon. I'm not trying to push you that invest in asset class A, B, C or whatever it is. That is your call. I'm simply outlining all the options. I hope you enjoyed this brief conversation. There are some of my other videos that I will link in the description and comment box. Please watch it in conjunction to this video. It will give you a lot of clarity in terms of developing and designing your portfolio. Thank you so much for watching, and I'll see you soon.